Hello all, welcome to GetintoIAS, and in this video we are going to continue with the lesson External Trade and Capital. Let's move into the lesson. So now coming to the depository receipts, okay. So what is a depository receipt? So under this, companies of a country can go abroad to sell their shares in foreign capital market. See, Indian companies, okay, Indian companies has to sell their shares, okay. For that they are going to a foreign country. In that foreign country, there is a foreign capital market to sell the shares, okay. So Indian company is going to the foreign capital market and trying to sell the shares. So far it is done, okay. So when a foreign investor buys shares of domestic companies abroad, he is issued a receipt by a custodian bank. So this Indian company can't issue the shares in the foreign market just like that. There will be a mediator in the middle. That mediator is called as the what? Custodian bank. Okay, custodian bank gets the amount from this foreign investor. It gets deposited in the custodian bank, and the share of the Indian company is bought by the custodian bank and then given to the foreign investor. Okay, so by giving this foreign investor will receive a receipt. So he will receive a receipt for the payment he have done. He has done the payment, right? He has invested in the shares, right? So for that he is receiving a receipt from the custodian bank. And then this receipt represents a certain number of underlying shares of domestic companies, and hence they are called as depository receipts. This receipt, what he is receiving from the custodian bank, is called as depository receipt because he has deposited his share in this custodian bank, and this custodian bank has invested in this Indian company. So this is called as what? Depository receipts. Now moving to the offshore funds. So before that, see here, the depository receipts raised by the Indian company in the American market is called as American depository receipts, fine. And those that are raised in some other countries are called as global depository receipts. Same way, the depository receipts raised by the foreign company in Indian markets are called as Indian depository receipts. So vice versa. Next, moving to the offshore funds. Done with the depository receipts, now offshore funds. Offshore funds are also called international funds, are mutual fund schemes investing in international market. For example, in India there is a mutual fund company, okay. What this company will do? It will pool in all the money from the public and invest in a foreign market, foreign capital market. This is called as what? Offshore funds. Fund is moving from here to another country. That's why it is called as what? Offshore funds. So the investment invested through these funds are included here. So other than that, we have the other flows. So after this, we have the overall balance or the balance of payment. So overall balance or the balance of payment. So under this, the overall balance is the sum of current account balance and the capital account balance. That is, overall balance is the sum of current account balance, what we already dealt with, and the capital account balance. So the sum of these both is called as overall balance or the balance of payment. See over here, balance of payment crisis you should understand. What is called as balance of payment crisis? See, when a country is exporting more and importing less, more amount of foreign exchanges, foreign currency will inflow. But when a country is exporting less and importing more amount of foreign currency will leave out of India. So the country won't be able to import more and more in the future. So this is called as balance of payment crisis. So under the balance of payment crisis, the country won't have enough foreign exchanges to cover the imports. Okay. Now coming to the reserves. What are called as the reserves? See, under the reserves, reserve mean foreign exchange reserve. Foreign exchange currency is called as what? Foreign exchange reserve. So the sum of the current and capital account balance is the balance of payment. So simply this is called as the balance of payment. And the balance is added to the foreign exchange reserve if the balance of payment is in surplus. See, if we have the balance of payment to be positive, that is if the exports are more and the imports are less, we will have more amount of foreign exchange reserve, okay. So that balance is added, that is the balance is added to the foreign exchange reserve if the balance of payment is in surplus. That is, if we have more amount of foreign currency adding, we will add that again and again to the foreign exchange reserve. We have a reserve, in that we have all the foreign currencies. So again and again, if the balance of payment is positive, we will be adding more currencies inside this, right. Then the balance is deducted if the balance of payment is in deficit. If we are importing more, it is a deficit, the country is going under deficit, then more amount will be taken from the foreign exchange reserve, fine. It means payment is made out of the old balance, that is payment is made out of the foreign exchange reserve. I hope you got the point. Now, the foreign exchange reserve consists of what? So, we have a box called as foreign exchange reserve. Inside this box, what and all are there? Inside this box, we have the foreign currency asset. It is in the denomination of the various countries' currencies. Next one, gold stock of RBI will come under the foreign exchange reserve. Special drawing rights, that is SDR holdings of the government, and the reserve tranche. All this is coming under what? Under the foreign exchange reserve. Very important. It is asked in the previous year question, that is what all constitute the foreign exchange reserve of a country. And this reserve tranche is a UPSC question, Prelims 2020 question. Okay. So, we will deal with that. Now, coming to the foreign currency asset. What is it? See, currencies of various countries are held in foreign exchange reserve. For example, it is expressed in US dollars or Indian rupee term after converting the currencies of various countries by their respective exchange rate against the US dollars or Indian rupee respectively. So, under the foreign currency asset, we may have various currencies inside that, or we may have only the Indian rupees pegged in term of the exchange rate. Okay. So, under this, apart from the currency, it also includes foreign currency deposits held by RBI. So, inside this foreign exchange reserve, we don't only have the foreign exchange currencies, but we have the foreign exchange currencies held by the RBI also with foreign central banks. So, RBI will be depositing in certain foreign central banks, right, somewhere in abroad countries. So, those are also foreign currencies. So, that will also account under our foreign exchange reserve. The BIS, Bank of International Settlement, and the non-resident deposit taking institutions as well as deposit agreements with the IMF trust accounts that are readily available to meet the balance of payment financing need. See, there is an account called as IMF trust account. IMF trust account. International Monetary Fund has an account called as IMF trust account. From this account, IMF will lend money to the member countries in case if it faces balance of payment crisis. Okay. So, next coming to the gold stock of RBI. RBI has gold stock as a backup to issue currency and to meet unexpected balance of payment problem. So, in case if our country is under the balance of payment problem, what RBI will do? RBI will use this gold stock for the balance of payment crisis. So, its value is expressed in terms of US dollars or Indian rupees, same way. So, next one is the SDR holdings. What is SDR holdings? Special drawing rights of IMFs are called as SDR holdings. So, under this, SDR is a reserve created by IMF. You know about that. This is a previous year UPSC question. To help countries have the balance of payment. So, I already told you they have the IMF trust account. That trust account is called as what? SDR. From this, they lend the countries, member countries for their balance of payment crisis. Okay. So, they lend the countries for the balance of payment crisis. So, the member countries have to contribute to this account. So, to this SDR account, each member country, India has to contribute certain amount because tomorrow we may face balance of payment crisis. By that time, we can take this amount. Okay, the contribution is in proportion with their IMF quota. So, each country has certain amount of quota. Okay. So, regarding that quota, on that quota, based on that quota only, we should what? Give money to IMF, SDR. See, next moving to the reserve tranche. There is something called as reserve tranche. What is it? So, it is this year's prelims question, prelims 2020 question, reserve tranche. Okay. Tranche means a portion or a slice. See, in a cake, if you cut into equal parts, you will get a portion or a slice. So, this portion or a slice is called as a tranche. Okay. So, a reserve tranche means a portion of the fund. So, tranche means it is a portion or a slice. What is called as reserve tranche? It means a portion of a fund. See, 100 rupees can be divided into 4, 25, 25, 25 and 25. Four parts it can be divided into. So, only a portion of this part is called as what? Tranche in monetary values. And here see, it consists of India's quotas, member subscription fee to IMF and lending to general resource account of IMF. See, same way, if 100 rupees is the STR, so total STR is 100 rupees. So, India is contributing how much? 25 rupees. So, this is the quota of India. So, how much ever India is contributing, this is the quota. Fine. Next one, general resource account is the pool of member countries' quota payment. So, on this whole, this 25 plus 25 plus 25 plus 25 contributed by various member countries is called as general resource account. Okay. So, a member is required to pay 25% of its quota in STRs or in foreign currency acceptable to the IMF. So in case if India is paying to the quota, right, it can pay in any currency. So that should be accepted by IMF, okay, in hard currencies. So this is termed reserve portion in the IMF or reserve tranche. So how much ever money India is contributing into the account, that is called as reserve tranche, okay. So under this, if any money was lent in foreign currency or STR over and above the quota to IMF's general resource account, it forms part of the reserve tranche. See, for example, certain countries have to club in money for the general resource accounts. If the contribution to the reserve tranche is more than this 25%, say 27%, this contributes the reserve tranche of the specific member country, okay. Now coming again to STR, special drawing rights. STR has two dimensions, okay. One, it is an exchange rate system, and another, it is a loan arrangement. So with STR, you can do the exchange rate. With STR, you can give loans also. Fine. So as an exchange rate system, first one, under the exchange rate system, the STR is an average exchange rate derived from a basket of 5 currencies. Very important. Previous year UPSC question, STR, right? So the STR, special drawing rights, consist of 5 currencies. 5 currencies. What are those 5 currencies? US dollar, Euro, Yen, UK pound sterling and Chinese renminbi. So Chinese renminbi was the last currency added to this STR, okay. So under this, as an exchange rate system, STR is an average exchange rate derived from the basket. So the average exchange rate is derived from this basket only, okay. Next one, in this system, these 5 currencies are assigned different weightage as their importance in the world economy, and an exchange rate is derived, which is called as STR. So what is special drawing rights? See, the average of all these currencies in the world, that is the average rate of exchange of all these currencies in the world are taken into account, and that average is derived, right? That exchange rate is called as SDR, special drawing rights. Now, the exchange rate of a country is expressed against STR. For example, Indian rupee is pegged with STR. So earlier, Indian rupee will be pegged with US dollars, but Indian rupee is now pegged with STR, that is the average of all these currencies, okay. For example, rupees 30 will be equal to 1 STR, fine. So this is how the STR is derived, fine. I hope you are clear. Next one, coming to the foreign exchange. Under the foreign exchange, we have what? We have the exchange rate. What is an exchange rate? See, it is the rate at which the home currency is exchanged for 1 unit of foreign currency. For example, see, $1 will be equal to 50 rupees, okay. So this is called as the exchange rate. Now coming to the depreciation. So under depreciation, increase in the exchange rate, fall in the external value of a domestic currency because of additional demand for foreign currency, or excess supply of domestic currency is called as depreciation. Depreciation is like $1 will be equal to how much rupees? 75 rupees, okay. The increase in the money value, in the sense 50 rupees has changed to 70 rupees. So for getting $1, now I should spend 75. Earlier I was spending only 50 rupees. Now my money has been depreciated, okay. Now coming to appreciation. Appreciation is the opposite of depreciation. Fall in the exchange rate, that is increase in the external value of domestic currency due to additional demand for the home currency, or less demand for the foreign currency is called as appreciation. So our currency has been appreciated somewhere in some other country, and hence what is happening? Our currency is being appreciated. For example, $1 will be equal to, again it will come down, 40 rupees. So this is called as appreciation, okay. Now coming to devaluation. Devaluation. So in all these things, that is depreciation, appreciation, it happens automatically due to the market forces. But this devaluation and revaluation, it is not like that. It is an artificial force. An artificial hand will come and play, okay. So under devaluation, reduction in the external value of home currency is called as devaluation. For example, changing the exchange rate from this $50 to the $75. So what is devaluation? See over here. See what is devaluation is, see today, $1 will be equal to 50 rupees, okay. $1 will be equal to 50 rupees. What I am doing? I am artificially devaluing my currency. How I am doing? $1 will be equal to 75 rupees. Why am I doing this? Why should I devaluate my currency first of all? See over here. If in case China is the country which has devaluated for a lot of times, okay, to increase their exports. For example, you have China and US. China will devalue its currency. Why it is devaluing its currency? See over here, US can get in a lot of products because China's currency has devalued. China's currency has been devalued. It can give $1 and get product worth 75 Chinese renminbi. Earlier, US citizens had to pay $1 to get a product worth only how much? 50 Chinese renminbi. So now they are getting a lot of products, right? So this is what is the reason why China is devaluating its currency wantedly. That is to increase the exports. The opposite of that is revaluation. That is to decrease the export. To distort the export, revaluation will be done. It is the opposite of devaluation. Now coming to purchasing power parity. What is called as purchasing power parity? We already dealt with this. See, PPP proposed by Gustav Kessel is a method of determining exchange rate. So with the help of purchasing power parity, you can determine the exchange rate between one country and another country. Fine. So a basket of goods will be taken, and from that basket of goods, how much people can purchase from that basket of goods from one country to another country. Two countries will be compared at a time. Okay. So look at here. Purchasing power parity refers to the equality of buying capacity. So how much they are buying. Based on the buying capacity of respective currencies, in their home country, the exchange rate is fixed. So there will be basket 1 in US, there will be basket 2 in India. So in this you will have various products like milk, vegetables, fruits. Okay, fine. So in this also you will have milk, vegetables and fruits. So with $1 in US, you can purchase this whole basket. But by paying 75 rupees, you can get this whole basket. So $1 is pegged to 75 rupees. This is how the exchange rate is calculated with the help of the purchasing power parity. I hope you got the point. We already dealt with this, right? Now moving to the needs for the purchasing power parity. See, it is a customary to compare level of development of different countries based on living standards of the people. So the standard of living is measured by proxy variable, namely per capita income. Earlier, the standard of living was calculated by the per capita income, how much I am earning. Okay. So people in countries with higher per capita income are considered to be enjoying higher standard of living, and such countries are considered developed countries. Earlier it was like that. Later it was realized that the standard of living is not in the amount of money they have, but the amount of goods they can have with that money. So I hope you got the point. It is how much amount of goods I can get with that money. It is not with the amount of money I have. Okay. So that is called as purchasing power of the money. So with this, the exchange rate is calculated. Fine. Now coming to the convertibility. What is called as convertibility? So under convertibility is divided into two: current account convertibility and capital account convertibility. What is current account? What is capital account? Before that, we'll see what is convertibility. Okay. See, as said in the previous passages, exchange rate is not free market determined. It is subject to some restrictions like trade. Removing these restrictions lead to convertibility. Okay. For example, facility of exchanging domestic currency for foreign currency at market determined exchange rate without restrictions on either rate of quantum of money exchange is called convertibility. See, I am having 70 rupees. With this 70 rupees, I am trying to get a dollar. So I am converting my 70 rupees into dollar. That is called as convertibility. In simple terms, that is called as what? Convertibility. Now, the currency convertibility refers to the freedom to convert our domestic currency into internationally accepted currencies and vice versa. Okay, this is called as convertibility in simple terms. Now coming to the convertibility in India, the convertibility in India is a gradual one. So right after independence, we didn't convert anything. Okay, it was a very gradual one. Like other reforms, it was also introduced in 1990s. Why 1990s? Because the LPG reforms took place in 1991. So convertibility in current account was introduced first, and then it was introduced in the capital account. So convertibility in current account was introduced first, and then convertibility in capital account was introduced after that. Okay. Now we'll see into the current account convertibility. What is it? See, current account convertibility refers to the freedom of converting the home currency into foreign currency with respect to transactions in current account. We already dealt with what and all constitute the current account, what and all constitute the capital account. So under current account, when you convert our amount into foreign currency, that is called as current account convertibility. For example, if I am doing any business from here to another country, so I will be converting my money. If I want to go for traveling, I will be converting. So all these are current account convertibility. For example, the budget 1992-1993 introduced liberalized exchange rate management system. What is called as liberalized exchange rate management system? In this system, very important, they may ask for prelims, liberalized exchange rate management system, LERMS. Okay. So under this, see, in budget 1992-1993, it was introduced. Okay. So under this, in this system, 60% of foreign exchange earnings are convertible at the open market. For example, if I have 100 rupees, okay, I need to travel. So for traveling, I need to convert this into dollars, okay, or any other foreign currency. Under this, 60 rupees was converted in terms of what? 60 rupees was converted in terms of open market trade, how the market exchange rate is going on. And 40 rupees was converted depending upon the RBI's fixed rate. So what RBI is telling me, only that I can convert. 40 rupees can be converted to $1 or $2 depending upon RBI's fixed rate. But the other 60 rupees I can convert it according to the market, like 70 rupees like that. Okay. So this is called as LERMS, that is Liberalized Exchange Rate Management. Now coming to capital account convertibility. Under this, the capital account convertibility means the freedom to convert home currency into foreign currency regarding transactions in capital account. So very simple. It is the same like current account, same way capital account. See over here, the Committee on Fuller Capital Account Convertibility observed as follows. For the purpose of this committee, the working definition of capital account convertibility would be as follows. See, capital account convertibility refers to the freedom to convert local financial asset into foreign financial asset and vice versa. It is associated with changes of ownership in foreign domestic financial assets and liabilities. So in case if a foreign country has given me loan, so that is an asset for that country, but it is a liability for me, I have to repay back to that country, right? So it can be converted into any currency. So this loan constitute under the capital account, right? So we already saw loans will come under the, that is the external commercial borrowings or external borrowings of the government will come under the capital account. So when we are getting loans from another country, that is called as capital account convertibility. Okay. And next coming to the barriers in the trade. We have two types of barriers. One is a tariff, another one is a non-tariff barriers. So what are called as barriers to trade? The policy instrument which obstruct trade are called as barriers to trade. There are two types, namely tariff barriers and non-tariff barriers. So under tariff barriers, tariff refers to the duty on import and export. So in case if I am exporting a product from India to any other country, say China, for this a duty will be imposed. So that is called as tariff, okay, to increase the price of the product, right? So these are the barriers to the trade. The reason for imposing tariff on import and export is different. See, the tariff on import is to make the prices of the imported goods equal to the domestic goods. So I told you the tariff will be implied to increase the price of that product. Why? Because there is a domestic product here. If a product is coming from China at a cheaper rate, say 10 rupees, if I increase the tariff, it will become 15 rupees. So in our country also, a product will be 15 rupees only. So for this purpose only, what? To equalize the product's rate, tariffs are imposed on both imports and exports. Fine. Now moving to the non-tariff barriers. What are non-tariff barriers? Under this you have various subheadings. First one is the quota. So under quota, I'll tell you before what is a non-tariff barrier. The instruments and executive operation that obstructs free flow of trade other than tariff is called as non-tariff barriers. So two things are used, the instruments and the executive operations. First one, non-tariff barriers are obstacles to imports other than tariffs. So they are administrative measures that are imposed by a domestic government to discriminate against foreign goods in favor of domestic goods. So to bring in our domestic goods, what we are doing, we are discriminating the foreign goods. For this, the non-tariff barriers are imposed. First one is the quota. What is a quota? See, it fixes a limit on the amount of trade that can take place. It is a system only a fixed quantity is allowed to be exported to a country and imported from a country. See, the government will tell you have to import only so and so. You have to import only 10 kilos of rice. You have to export only 10 kilos of rice. So this is fixed by whom? This is fixed by government. So that is called as quota. So there are certain quotas. For example, see, US will have 11% of quota, that is, it can export 11% of a specified good. But China will have only 5%, only 5% can come into India. So this is called as what? Quota. Fine. Next, moving to production subsidies. Under this, production subsidies are given by government to producers of exportable goods for the production of goods and services. They are in the form of raw material at low cost, credit at low interest rate, tax concession. We already saw this. Production subsidies means, for example, if I have a company in India, I am producing something, for this the government is giving me subsidy, okay. For example, subsidies can be given like, I'll be getting raw material for production. That will be for low cost for me, okay? Or they'll give me loans at low interest rate and they'll give me tax concession. I'll be paying excise duty for this, right? That will be written off. Fine. Next, coming to the export subsidies. Under the export subsidies are given to the post-production stage. So, after I am producing this product, after this I should export this product, right? For that, the government will give me certain subsidies. So, they are in the form of transport subsidies and low-cost shipment credits. By this, our product rate will come down and hence we can export more. Fine. Next one, coming to the health and sanitary. So, we have done with quota, we have done with production subsidies, we have done with export subsidies. Now, moving to health and sanitary. So, under this, it refers to the import restriction on health and safety grounds. The countries that want to restrict import fix higher level of norms. For example, if US is here and India is here, US doesn't want certain products coming from India because on lines relating to health and sanitary, and hence what it will do, it will fix certain qualities. So and so quality only I need, then only I will get. So what India will do, the cost will increase for India, the input cost will increase for India and hence it will stop exporting, right? So over here see, the norms include, for example, the residue of pesticides in food products, level of germs. For example, only so and so percentage of pesticides or the fertilizers should be in your food grains. So they will fix the amount, how much amount should be there. In case if it is more than 10%, the fertilizer or pesticide amount is more than 10%, that is say 15%, they will cancel the exports. Okay. So next, coming to the packaging requirement. See over here, it is same to the health sanitary regulations. See, by fixing the packaging requirement, high restrictions are imposed on trade. So the standards push up the cost of the product. So the import comes down. So sometimes the cost of the packaging exceeds the cost of product because of higher packaging requirement. See over here, if a pickle is produced in India, see the pickle price is 50 rupees only. But the cost of packaging is to be 150 rupees. So the total cost of the product is 200 rupees. So US government will be like, they'll tell my packaging should be in this standard. So for the production unit in India, the packaging cost is more than what? The product cost. And hence, will they tend to export? No. So the exports will come down. So this is what is the packaging requirement under the non-tariff barriers. Okay. Next, coming to the economic integration. Economic integration refers to the cooperation that exists between countries in the trade and other economic fronts such as investment and monetary policies. So apart from trade, the investments and the monetary policy club together, okay, forms the what? The economic integration between country 1 and country 2 or more than 2 countries. Fine. So under this, the level of integration varies between countries. So the economic integration between country 1 and country 2 will be nice. So Russia and China will have a close economic integration. So China and US won't have that much of economic integration. Okay. So on the basis of the level of integration, there are various names for it. Though it is difficult to differentiate them, it is explained, they are telling. First one is the preferential trade agreement. What is preferential trade agreement? So under this, it is an agreement between 2 or more countries where the agreeing parties reduce the level of tariffs imposed on traded goods among themselves. So it is the first level of economic integration. So this aims to bring down the level of tariff and thereby increase the flow of trade. The parties to the agreement maintain their own tariff level with the third party. See over here, country 1 and country 2 will have same amount of tariff. If 10% tariff is implied on a product, country 1 will also export this at 10% and country 2 also will export this at 10%. They may have at a different percentage with country 3. They may have with 13% with the country 3. But between these 2 countries, there will be a nexus. Okay. This is called as preferential trade agreement. This is the first phase of the economic integration. Now coming to the second phase of economic integration, that is the free trade agreement. So under the free trade agreement is an improved level of economic integration compared to the preferential trade agreement. So in this agreement, the parties involved in the agreement abolish tariff on most of the goods and services and keep tariff on some items at a minimal level. So the tariffs will be abolished for most of the goods and services, or it will be kept at a very minimum level. So some goods which are identified as sensitive goods are continued to be traded at existing tariff levels. Okay. So see, in recent times, the free trade agreement is called with different names. There are Comprehensive Economic Cooperation Agreement, Comprehensive Partnership Agreement and Economic Cooperation Framework Agreement, but all of them are the same. So all of them are free trade agreement only, but they're called by different names by different countries. Okay. Next one is the customs union. Now coming to the customs union. So we're done with preferential trade agreement, free trade agreement. Now coming to customs union. So under the customs union, it is still higher level of integration. In this, the member countries abolished barrier to trade and services among them. As a whole, they maintain a common tariff against the third party. See over here, earlier I told country 1 and country 2, inside them it will be 10%. The tariff will be 10%. But see, country 1 and country 2 may have a tariff of 10% on the goods. But see, they'll have a common tariff on the third country. See, 13%. See, earlier, country 1 would be having a 15% with this country 3 and country 2 will be having 17% with the country 3. But under the customs union, it will be like, there will be a common tariff for the third party country also. See, it will be 13% at fixed for the third country also. So, I hope you got the point. Now coming to the common market, so under this, in addition to provisions of customs union, a free flow of labor and capital is allowed in the common market. So in addition to the customs union, there will be a free flow of labor and capital in the common market. So laborers can go to and fro from that country to this country and capital will go to and fro from that country to this country. Okay, that is called as what? Common market. Now coming to the economic and monetary union. Fine. So in this agreement, in addition to the common market provisions. So in addition to the common market provisions over here, the monetary and fiscal policies are harmonized among member countries. Common currency is also an important feature of this union. Very important, see over here. For example, in European Union, the common currency is euro, right? They have the common currency called as euro. That is a kind of economic and monetary union. Okay, and most of the administrative reforms and the monetary reforms will be equalized. That is, all the countries will follow the same administrative reforms and the monetary reforms and they'll have the same currency. Okay. So now coming to the related terms, under this the first subheading is the comparative advantage. What is called as comparative advantage? So under here, comparative advantage theory says that the country has to produce and export the goods which it has comparative advantage. For example, I'll give an example over here. See here, assume that India and Bangladesh produce rice and wheat. Okay, so India and Bangladesh produce what? Rice and wheat. Okay, so for this, in India, the cost of production of 1 kg of rice is 25 rupees. So cost of production in India is 1 kg of rice is 25 rupees. And the cost of production of wheat is 60 rupees. And for wheat, it is 60 rupees. Okay. So same way in Bangladesh, the cost of production of rice is 50 rupees. So the cost of production of rice is 50 rupees and of wheat is 75 rupees. So see over here, the cost of production in India is only 25 rupees and the cost of production of wheat in India is 60 rupees. But see in Bangladesh, for both it is high, right? So over here, India has a comparative edge when compared to Bangladesh. So other countries like US, UK, China, Australia, all will tend to import rice and wheat from where? Rice and wheat from India, because the cost of production over here is less and hence the selling rate also will be less when compared with Bangladesh. So what should India do? India has comparative advantage over rice and wheat. Next, coming to the topic of rules of origin. So under rules of origin, see, it is a term used in the trade agreement. So under the trade agreement, we saw the various trade agreements, right? Under that, there is a clause called as rule of origin. Okay. So it is aimed at preventing third parties from routing their products through member countries to take advantage of low tariff and allowing only goods that are originated from parties to the agreement. For example, take India, China and take some other middle country like Sri Lanka. Okay. See, if India is importing certain goods from Sri Lanka, the tariff for that is only 5%. But the same goods, if it is importing from China, the tariff for that will be 10%. See, China has to pay a lot of tariff if it sends its goods directly from China to India. But if it routes its product from China to Sri Lanka and then to India, it takes only around 5 or 6%. Fine. So this is called as what? Routing of the products because of low tax advantage that India gave to Sri Lanka. So to eliminate this trade practice of routing, the rule of origin was introduced. Okay. See over here, the rule of origin is usually determined by two criteria, namely the value addition or local content requirement. So there are two terms called as value addition or local content requirement. So under this, see, if in case a battery is coming from China, so the rule of origin is like made in China. It should denote its country's name in the product, okay? And then see, the battery is imported to India, but India is having a clause like 50% of the product should be made in India, and hence by this you will know if a product, if it is fully made in India or it has components imported from some other country, okay? So let's deal with this. See over here, value addition requirements stipulate that the goods which are not fully originated from the partner countries should have a value addition in the term of raw material, labor cost, etc. as agreed by the member country, usually 30%. So usually the value addition for a product will be 30%. Okay. So next, coming to the change of tariff heading at 4-digit level. What is called as change of tariff heading at 4-digit level? So tariff heading represents the code assigned to various products under harmonized commodity description and coding system of World Customs Union. So there is a customs union, we already saw, right? World Customs Union. Under this we have a system called harmonized commodity description. Okay. So tariff heading represents the code assigned to various products. See, for example, take product 1, there will be a code assigned to this product. So that code is for the harmonized commodity description, a coding system under the World Customs Union. So for what are they using this harmonized commodities description? See, the first 4 digits of the code are called as heading. So I told, right, there are certain assigned codes for this. In that you have various codes for various products. In that the first 4, 1, 2, 3, 4, the first 4 codes, first 4 numbers are taken into account. See here, the first 4 digits of a code are called as heading. So these 1, 2, 3 and 4 numbers are called as the heading. Fine. The subsequent digits are called as subheading. If there are more codes to this harmonized commodity, over here after these 4 digits, these are called as subheadings. Fine. And then change of tariff heading means a product that does not originate from a country should be codified in different heading when exported. Fine, that is, a product should be converted into another product while exporting. For example, the code of live bovine animals is 0102. To be exported, it may be processed and converted as frozen meat of bovine animals, for which code is 0202. For example, take a cow, okay? Take a cow. When it was alive, the code of the cow is 0102. But after cutting into meat, the code of the cow, that is the parts of the meat, will be changed to 0202. Fine. So this is the head count. Okay. So these are the rules of origin. So while exporting to another country, you should follow all these rules according to the World Customs Union. Next, coming to the debt service ratio. What is called as debt service ratio? The amount of a country's debt service, repayment of principal and interest as a ratio of its total export earnings is called as debt service ratio. See, for example, India. Okay, India is here. We have a debt, right? We are getting loan from some other country, take US. So we are getting the debt, right? So under this, the amount of country's debt service, that is the principal plus interest I should pay back to US, right? This as a ratio of its total export earnings. India is exporting a lot of products. For that it is earning. For that it is what? It is earning. Okay. So this ratio is called as debt service ratio. So it can be written as debt service ratio will be equal to debt service divided by total export earnings. Fine. So this is the formula for debt service ratio. So next, coming to the last topic of this lesson, NEER and REER. What is NEER and REER? See, NEER stands for nominal effective exchange rate. So nominal effective exchange rate is NEER. What is NEER? And REER stands for real effective exchange rate. Usually the exchange rate is determined for a domestic currency against a single foreign currency. See, for example, $1 will be equal to 70 rupees. This is how the exchange rate is determined. See, but under this, the effective exchange rate is fixed against a basket of currencies. For rear and near, the basket is STR currencies. See, normally $1 is 70 rupees. You are comparing the exchange rate to what? The dollars. But under rear and near, this effective exchange rate is compared to a basket of currencies. For example, under STR. Under STR, we have 5 types of currencies, right? So, based on that, the exchange rate of a currency is determined, okay? So, exchange rate will be determined according to this basket, okay? Now, the rear is arrived from near. The way real GDP arrived from nominal GDP after correcting it for price change. See, they are telling rear is arrived from near. That is, the real effective exchange rate is arrived from the nominal effective exchange rate. Fine. See, the formula for near is domestic currency. Domestic currency exchange rate in terms of STR divided by foreign currency exchange rate in terms of STR. So, this is the formula for near. Domestic currency exchange rate in STR will be compared and a foreign currency will be compared in terms of STR. What is rear then? Rear is derived from near, right? So, rear will be equal to near into domestic price index divided by foreign price index, okay? So, over here we have something called as the price index. So, we already dealt with price index, right, under the WPI and CPI, right. So, over here the price index is CPI combined. So, we have a price index can be divided into WPI and CPI, and over here the price index is calculated to be the CPI combined is taken into account. CPI combined is taken into account for the domestic price index. So, over here you have price index. And the price index is CPI combined. The way it is calculated by the basket of SDR currencies, there are 2 other EERs, effective exchange rates. One is based on the top 6 trading partners currencies and another is based on the next 36 top trading partner currencies. See, I told you all CPI combined. Over here the price index is taken, and after that the way it is calculated by the basket of STR currencies, there are 2 other effective exchange rates they are telling. So, there are 2 other effective exchange rates also. What are those 2? See, one is based on the top 6 trading partners. For example, see, India is trading with many countries. Under that, the top 6 most countries that will be taken into account, and the next EER is below that there will be another 36 countries. So, under that the exchange rate will be calculated. So, this is all about near and rear. And with this we come to the end of the lesson, external trade and capital, and that's it. Thank you for watching, and please subscribe to GetintoIAS and follow our Telegram channel link in the description box given below. Thank you for watching.